So what does the EMH say? In simple terms, it says that in an efficient market, you cannot consistently earn abnormal risk-adjusted returns after cost. In other words, you're better off buying an ETF because you cannot systematically beat the market once we adjust for the risk that you're taking. So you can be lucky for a year, but there is no magic formula that reliably outperforms over and over without taking on more risk or paying more cost. And within that idea, that big idea, you have three versions of the efficient market hypothesis, depending on what information we assume is already reflected in the price. So the weakest form, you have no efficiency at all, that would be the weakest form, but in the efficient market hypothesis, the weak form is, it says that historical market data, so past prices and trading volume, are already priced in, which means that technical charts or pattern analysis, because they look at those charts and patterns, they cannot generate abnormal return according to the weak form. Semi-strong form is the same idea or same concept, but it says that yes, the historical market data is included in the price, but not only. Actually, all public information is included in the price. So following the news, analyzing financials will not give you abnormal return. You cannot beat the market with that. It's already priced in. And the strong form, that is obviously not the case, it says that prices reflect all information, public and private, including insider information. So if you are the CEO and you know tomorrow's earning, then you would still not be able to earn abnormal return using that knowledge. And because insider trading is illegal, it's obvious that private information is not reflected in the price. And in practice, people debate how close we are, to one form of efficiency or another, but it's not relevant for the curriculum and the exam. What matters is that you remember the three definitions. Now, quick parenthesis, a big part of why the markets are efficient or that increase efficiency is arbitrageurs. Because, so arbitrageurs are those that look for mispricing and ideally at no risk, an asset that is underpriced here, overpriced there, so that they can find the anomaly and exploit it to make a profit, potentially at no risk. And because of their work, because of this activity from arbitrageur, it removes inefficiency and brings back the assets to their fair value. So the efficient market hypothesis assumes that there are enough of those arbitrageurs, the information flows, that the markets are liquid,